I'll just put on the floor here. He who's...
Hello? Oh, hello? Good morning, everyone. Good morning, everyone.
How is everyone doing? Did you get
How is everyone doing? Did you get breakfast? You got your coffee? You're all excited for a great event this morning?
Okay, good.
Okay, good, good.
My name is Ryan Grunenfelder.
My name is Ryan Grunenfelder. I am Director of Advocacy and Outreach for AARP in Illinois.
And I just want
to welcome all of you to today's event where we have our featured speaker with Terry Savage, and we have a day-long of events with multiple different speakers and a whole bunch of topics. So I hope you are able to get a lot out of it. I wanted to share a bit about AARP and AARP Illinois. As it turns out, we're actually in a historic area right now as far as the founding of AARP goes. Just outside the building, and actually I can see it through the window over there, is the Jane Addams Hull House. In the late 1800s, AARP's founder, Ethel Percy Andrus, she and her family moved to Chicago from San Francisco, and Chicago's actually where she spent her formative years. She lived in the Austin neighborhood with her family, grew up here. She went to the University of Chicago, got her college degree and her doctoral degree, and then she also worked at Lewis University, both teaching and as a student. But during that time, she developed her passion for service, working at and volunteering at the Jane Addams Hull House, and spent a lot of time there. So we like to think that, especially those of us in Illinois who work for AARP, like to think that that's really where she developed her service for passion for doing service for people. And in 1958, she ended up founding AARP. So just a little bit of wonderful history there today. So AARP Illinois worked this year to make this event happen as part of our Maximize Your Money campaign, because we have been listening to you. We have 1.7 million members across the state of Illinois, and we do a lot of work to support all of you, to support the 50 plus, to support their families, their family members, to ensure that everyone is able to age with dignity and with respect and have the best possible life you can. And what we have been hearing is that everyone is concerned about their financial security, concerned about the future of Social Security. You're concerned about your investments. You're concerned about your ability to live long into retirement and be able to have the resources that you need to support yourselves. And I know it's been tough, especially in the last few years, and we have heard that too, considering the pandemic, considering the significant inflation that has been happening, the rising costs of health care and prescription drugs. Members across the state of Illinois and across the country have been telling us that for a consistent period of time. So we decided to prioritize our work on pocketbook issues, and that's why we're here today and why we have put this event together. So just to share a little bit of data, and this is according to some surveys that we did with Illinoisans, actually 45 plus. Over 90% of Illinoisans over 45 are worried about having enough money to retire and having adequate Social Security benefits. Over 90%. That was a huge number to us in a survey. 3/4 of Chicagoans are anxious about having enough money in their retirement years. And those very anxious was particularly high among Black and Latino Chicagoans. 4 in 10 Chicagoans ages 45 and older are tenants and not homeowners. So they are able to take advantage of ways to, they're not able to take advantage of ways to save through home equity and tax deductions and having an asset to rely on as part of some of their retirement income. So it's for those reasons that we are here today. Those numbers speak a lot to us and help us prioritize the work that we do in the state of Illinois to make sure that we're supporting you, not just on financial security issues, but on issues related to nursing homes and the quality of life that people would have there, on home and community-based services in the community, on rising utility rates, and I know that's been a particularly tough issue here in Chicago with the high cost of gas and a lot of cost overruns that are happening with people's gas here. So that's the work that we do, but I know you're all here to see our keynote speaker today. So without further ado, I'm going to introduce Terry Savage. Terry is a nationally recognized expert on personal finance, the economy, and the markets. She writes a weekly personal finance column syndicated in major newspapers by Tribune Content Agency. She appears twice weekly on WGN Radio and WGN TV in Chicago, commenting on financial news. She co-hosts a weekly podcast called... Okay, she's
The
ready to
older
get
you
started.
get, the
So,
longer your bio goes.
please just join me with a round of applause for Terry Savage.
Thank you, Brian. Okay, I could tell that he was getting into the long bio, and I thought, oh, no, it's true. The older you get, the longer your bio gets, and it takes up your time. I'm so glad to be here. It's not the first time I've worked with AARP. A few years back, we did some seminars around the area. But because of COVID, there hasn't been much happening in the last few years. And I think this is the first time in general and public in Chicagoland that I've spoken in the last few years. I am delighted. I know some of you drove in from the suburbs, some of you are from the nearby neighborhoods, and I just want to compliment AARP, which has always been at the forefront of helping people deal with every other issue, but certainly with financial issues. I'm just very proud to be associated with you. Thanks for calling again. So now, this is an interesting audience. I only know one cohesive thing about you, and that is that AARP reached you, so you're grown-ups. All of a sudden I realized I'm a grown-up too. I see a lot of gray hair. Yesterday I spent all day making sure you could not even see one gray hair. But other than that, we're all in this together. Some have more resources and therefore choices to make. Others have fewer resources and the choices are not as easy or comfortable. I'm going to try and hit on a wide variety of things. My goal today is for you to walk out of here with one aha moment that can change your life, help it for the better. If you get 2 or 3 out of it, then I'll just be dancing on air. I want to start a place where I start with all my speaking engagements, and have for the last 20 years. I created this after 9/11. Don't bet against America. America will survive and prosper, and so will you. Yes, if you plan, save, and invest. All of us here are old enough to know, because we're here because we're survivors, that we've been through a lot of tough times. We remember our parents or grandparents, World War II. We remember the Vietnam War that was at the beginning of our lifetime. I say our in the collective sense here. We've had huge inflation. I still live in a house that I initially bought in 1981, where the seller took back a mortgage loan of 15%. I refinanced it about a year later to 13.5%, and I said, see, I'm a great trader, I know what I'm doing. Then I refinanced it out to 9.9%, and I went, I'm so smart, and then I paid it off, of course. But the fact is, we've lived through that kind of stuff. We've lived through the stock market crash of 1987. We've lived through the 80s, the recession with the horrible unemployment. Gary steel mills were closed down and so forth. We know we can do it, and now for sure we're going to be able to do it through this last section of our lives. Our kids are the ones that are panicking because they think jobs are something like, well, I'm in this slow quitting mode. I'm not going in. If they insist I come back to the office, I'll quit. Or I'm just going to do the basic, the very minimum. I don't have to do extra. There's going to be a whole generation that are going to learn their lessons the hard way. There's an old savage truth. The lessons that cost the most teach the most. And you nod because you know that. Don't try and tell them. They're just going to have to learn it on their own. We're here for us today. Okay. Now, there was a long time we defined prosperity in the 80s and 90s, I think, as getting stuff. There were houses, and there were houses with 2-car garages, and there were houses with 3-car garages, and then there were mansions. It was all about showing stuff off. It was fur coats and designer purses and credit cards charged up to the limit. We know now that the real financial success and prosperity is just peace of mind. Being able to sleep at night without waking up in the middle of the night wondering and worrying about how you're going to pay the bills. Everything in this program today is designed to help you. So if I start talking about investments and you're going, who does she think we are? Investments, I'm just trying to make the monthly bills. There are going to be a whole series of workshops here. Everything from dealing with your utility bills. I'm so glad to see Social Security here for some wonderful advice on that, and a session on actually budgeting and using some of the things I'm going to mention today. So I hope you'll stay for the whole day. My goal is to give you an overview, and again, I hope there's something for everyone. So even if you're not interested in the stock market, I think you need to know something about our economy. You need to have some perspective. We don't live blindly. We're all in the same boat. It rocks differently for some people. And let me just give you a little bit of quick overall perspective. I did this chart last night. This is the Dow Jones Industrial Average. It closed at 34,400 something. The high, the all-time high, was was just before the pandemic at 36,952, about 37,000. So of course you see that big dip in the middle. That was the pandemic when the world shut down. This is 10 years, and then we had that incredible rally. And lately, even if you're not invested, you hear it on the news. Market was up 700, down 500. The Fed's this, da 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 da. Basically, we're not doing so bad over the long run for anybody who is either invested in stocks, or maybe you have an IRA or a pension that is itself invested in stocks. The stock market is doing pretty well, but if you didn't have your seatbelt fastened and you looked over the cliff, one of those big down swoops that happened, you would just go, oh my God, I've got to get out of here. The fact is, over the long run, the stock market does pretty well. This is a 10-year Treasury rate. You know, we have a national debt that is huge, and we finance it, the government, by selling IOUs, Treasury bills, notes, and bonds. The 10-year Treasury notes that they sell at auction once a month, the interest rate is set by global bidders, the foreign central banks and big banking institutions, based on how much interest do we need them to pay us so that our money is worth something when we get it back. What are we worried about? Inflation. So last night, the closing 10-year Treasury bill rate was 3.5%. That's part of our national debt. That's the 10-year Treasury. I'm going to talk about what you can buy later. But interest rates have climbed. You can see that at that dip, which was just about a year and a half ago, 10-year Treasuries were yielding a little over 0.5%. But because the world perceives inflation in America, they demand a higher rate. Now, you and I could walk into XYZ Bank and say, excuse me, you're paying me 0.5%. Don't you know that inflation is a lot higher? But they're not going to listen to us. But the global bond market listens to what's going on with inflation. Yes, inflation is much higher, but the bond market is looking ahead 10 years and says 3.5% is about what it should be. Consumer confidence. I want to bring this up because that big dip, the shaded spot, was 2009. You remember the mortgage and the housing crisis. All during that, I was saying to people, no, don't walk away from your home. Your home's going to be a great investment. In the last year alone, housing prices were up 35% nationally. But that crisis, where people were allowed to buy homes with no money down, and then they lost their jobs in the recession and so forth, was a horrible one, and it destroyed consumer confidence. Then, see the next big decline? That was the pandemic. Everything shut down in America. Of course, consumers lost their confidence. Then we had this huge rally. We've got vaccines. I mean, I could still feel the sigh of relief. I still carry my vaccine card. Do you carry your vaccine card? Yeah. I mean, I don't know why nobody's ever, for years asked for it, but it's like, thank you, there's a vaccine. I mean, 2 years ago, it'll be almost 3 years ago, because in March, we thought that if we accepted a package from UPS, it might have a vaccine on it that could kill us. You know, I mean, seriously. So what a sigh of relief, and consumer confidence has rebounded. But now we saw inflation peak in the last year. That's at peak. And people realized it was gasoline prices, it was food prices, it was everything, and consumer confidence declined. I didn't put in a chart of consumer spending, but we just had a report. Consumers are spending like crazy, but where's it all going? On their credit cards. And consumer debt took the highest 1-month jump in 40 years, percentage-wise. So consumers are still out there spending. They're so relieved there's a vaccine and we can all go out again, but they're building up a lot of debt. Today's headline topics, if you're going to look at the economy and make some financial decisions for yourselves, is what's going to happen to inflation, I don't need to give you Inflation 101. You went through it once. You did survive. Now you're going through it again. It's a little different once you're retired and you don't get to work overtime or ask for a raise because inflation, of course. So inflation, how's that going to impact you once you're retired? Recession. Is there a recession on the horizon? Why would there be? Who's trying to create it? And how will that impact you? And then this issue of debt. How dangerous debt is when interest rates are rising, because interest rates are not only rising for mortgages and the Fed's trying to slow things down, I'll talk about that, but interest rates on credit card debt outstanding are going to rise dramatically. And if you're hooked, you're hooked. So senior bankruptcies before the pandemic were the fastest growing category of bankruptcies, as people come into the moment where they realize, I don't get overtime, I don't get to work Saturdays or something and make it up. And I don't want that to happen again, and I really dread that bankruptcies, if there is, and I think there will be another recession, will impact seniors more than ever. So let's just talk about inflation, okay? Here's the CPI, Consumer Price Index, just over the last 20 years. And you remember it was hovering around 2%. That big dip is, again, when the recession of 2008-09 hit. Home prices went down, excuse me, and the economy slowed. But after that, from 2010 all the way through to 2020, for 10 years, inflation, that line, we even got to the point where inflation looked like it was going to turn into deflation. Interest rates were low, there was no inflation. There was no inflation. The Fed was worried there was no inflation. We'll be going down a black hole. And then came the pandemic. And they started pouring money into the economy. I'm not political. It started under one administration, continued on another. I'll never forget the first time a stimulus check was announced. I said, they're just going to give everybody money? And then there was a second stimulus, and it was like Oprah. You get a car, you get a car. It was astounding. And add to that, doubling of the unemployment benefits and the child tax credit. There were just, money was floating around. The PPP loans, which never had to be repaid. And the government just went deeply into debt, sold Treasury bills, notes, and bonds. And who bought them? The Federal Reserve. They bought them and paid for them with newly created money that went into the system. It's called liquidity. Now, liquidity works with a lag, and so does tightening. But for sure, that money floating through the economy caused inflation. And that's what we're dealing with now. Don't argue with me. That's just a basic fact. There are a lot of people that our economists argue the delay and the this and that, but everybody knows the Fed has, I won't even go into how the Fed Reserve works, but it has a balance sheet. It buys this stuff, pays for it with money. Nobody ever says to the Fed, could you put your driver's license number on the back of that check? You know, the big institutional bond dealers buy the bonds from the Treasury, and the Fed says, we'll buy those. They pay for it with new money into the system, and that's what's happened. It's not the worst inflation we've ever had. I alluded to the fact of the 1980s. These two peaks, the first ones are World War I and World War II, when there was a scarcity of goods coming out of the war and prices went up. The Twin Towers in the middle were the inflation in 1980 and 82. Then we had two recessions back to back as Paul Volcker raised interest rates to that 20%, 15% prime rate, 20% prime rate, 15% mortgages, and you remember that. And then he let up too soon. Notice the Twin Peaks there. He let up too soon, and then inflation soared again. It was like a firefighter not putting out all the embers, and so inflation picked up again, and that's when interest rates really peaked. That informs what's going on at the Federal Reserve today. They do not want to take their foot off inflation before it's really burnt, they've really killed it. So now we see inflation picking back up, and in spring this year it was, depending on the numbers you looked at, 7, 8, 9%, and that really got the Fed scared. So inflation is, we define it as rising prices of everything you buy. Basically, in this case, it was too much money pumped in a very noble effort to save people from the pandemic, where there was a complete shutdown. And then too few goods, and a lot of that too few goods initially was the supply chain disruptions from the pandemic, which caused the Fed chairman, Jay Powell, to say, well, it's only going to be transitory, because we'll get our factories up and running and our supply chains up and running, and then we'll have plenty of goods, so it will just calm down. But inflation gets built into the system. And everybody who's still working demands a wage increase. So just yesterday they announced that the unemployment numbers, wages are up 5%. I know, you're retired, you don't have wages, that's not fair. Meanwhile, they were keeping interest rates as low as they could all this time, so literally screwing savers. Well, we're going to get to that, I have the answer for that. But inflation is really dangerous. And the solution, the only solution the Fed has is, Congress passes the bills that spend the deficit spending. The Fed's only solution to deal with inflation is to raise interest rates, thereby slowing down the economy, thereby slowing down demand, thereby letting the air out, and the way they do it is create a recession. And Jay Powell has said, once he got past transitory, a recession will be painful. It will cause rising unemployment, because that's the only way we can slow it down. And yesterday's unemployment numbers were in a sense disappointing, and they show the economy is strong and resilient. And more new jobs are being created, and a lot of people have gotten out of the workforce completely. And there's still about 10 million unfilled jobs in the economy, maybe because they were the ones immigrants used to do and Americans don't want to do them. Your kids and grandkids don't want to do them. You're too old to do them, the backbreaking work. Or maybe because people just think that it doesn't matter, that they'll get benefits. Whatever it is, there's 10 million jobs unfilled and more jobs being created and more pressure upward on wages. So the Fed's job isn't done. That was the conclusion after yesterday's unemployment report. Now, you won't ask this, but when I speak to younger audiences, I have to explain to them why inflation is a bad thing. If you know inflation's a bad thing, nod your head. Yes? You know inflation's a bad thing. Okay, I gotta laugh. Inflation absolutely destroys your financial security. It makes the value of your savings buy less. There's an old saying in finance, it's truth. The rule of 72, divide any number into 72, and it will tell you how long it will be for that number to double. So if you put 3% inflation into 72, your money loses half its value in 25 years. Now, let's see if we remember our math. Suppose you have 7% inflation, which is what we have been having. Divide that into 72. How long does it take for your money to lose half its buying power? 10 years. Now, once you get to the gray hair stage, you start dividing by 10 pretty easily. I'll live 10 more years, I have this much more money, I get X amount a year, you know what I mean? Well, at 7% inflation, your savings, your fixed monthly pension loses half its value in 10 years. That's something we can see. And that's why, not only because we're old and we're not working and we don't care if our grandchildren lose their jobs, but because we only have savings to rely on for the most part. That's why we know we have to support the Fed in fighting inflation. It's not a political thing. Inflation's going to destroy everything we've worked for. If you have a home, yes, your home will go up in value, and it has over this last few years. But for many people, and I just heard Ryan's statistics, who are renting and who only have a bit of savings, it's not your imagination. I just bought a pound of butter for $6. I never noticed what butter was. I didn't know that eggs, okay, I like extra large eggs, $6. I know that was only $1.50 in a couple of years ago. And I know they're not paying chickens anymore to lay those eggs. Very annoying. Okay, so let's talk about the challenges you face in retirement. Some of you have investments. Some of you don't even think you can afford to retire, which is perfectly understandable. It depends on your lifestyle and depends on the income you have coming in. And how do you get to the place where you have peace of mind? So I want to talk about some just basics for investments, because every time that we get a slowdown in the economy, we get economic woes, scams arise because people are so desperate they see the value of their savings shrinking. I want to discuss risk and reward. When you make money decisions, you have to make them very calmly, because there are two emotions that arise whenever you make a money decision about, do I do it or do I not? They are fear and greed. Now, fear paralyzes you, and it can keep you from doing the right things with your money. But greed is so devastating. A whole generation of people thought they could loan money to crypto firms and get 20% interest. Please. Scams are out there now. People forward them to me. I forward them to the FBI. The FBI says, Terry, mention it on radio or television. They're out there. It's growing. It's growing. Understand, there's no free lunch out there. I'm going to give you some good ideas for a little bit of an appetizer, but no free lunch. So when someone offers you something outrageous, you have to have your intelligence finely tuned to the balance between risk and reward. Those are opposite sides of the coin. Now, in the stock market, there are the bulls and the bears. You with me over there? Should I come over here? I can come over here this time. Okay, there are the bulls and the bears. The bulls think the stock market's going up, and the bears think it's going down. I add a third category: the bulls, the bears, and the chickens. Okay? Chicken money. And I coined that term, I don't know, maybe 40 years ago. I mean, I understood that term intuitively. Chicken money is very simply money that you cannot afford to lose. Even rich people should have chicken money. Obviously, the Sam Bankman-Fried with the crypto thing had no chicken money. He thought we were all chickens. Turkeys, he thought we were. Chicken money, it could be that you're in your 20s and you're saving up for a down payment on a home. So you don't want to risk it, even though someone says, I got a great investment for you, but because you're so close to getting that down payment, you're not going to risk it. It could be because you're older and retired and you don't have money coming in anymore, very much of it anyway, and so you need to keep some safe. Chicken money lets you sleep at night, and you can only put it in a few places, okay, because otherwise there's that risk factor. You can put it in bank deposits, money market mutual funds, Treasury bills, I-bonds, and AHA. Remember I mentioned, and you noticed for sure, that the Fed kept interest rates low to keep the economy growing when they were worried about slowing down into deflation. There was no inflation. Interest rates were low. And the banks didn't need your money because the Fed was pumping plenty of money in, so they weren't offering you toasters or high interest rates, and they aren't now. Remember the mantra of the chicken money investor. I'm not so concerned about the return on my money as I am about the return of my money. Well, it was very painful to be in those low-yielding money market accounts, 6-month CDs for the last 5 or 6 years. I eat my own cooking, so me too. But finally, chicken money is paying off. Now, I hope some of you caught me over the last 5-6 months, because up until October 28th, U.S. savings bonds, the things you used to buy for your grandchildren, Series E at a discount, $12, it was a $25 bond, hold it and cash them in when you graduate, kid, you're on your way. Now, those not what we have anymore. We have Series I bonds. They were paying 0%, literally 0%, 0.1% forever and ever and ever. All of a sudden, that every 6 month inflation adjustment popped up. And starting last February, the Series I bond had a 9.62% interest rate attached to it. Did any of you get any of those? All right. I would have put my life savings in it, but they have a limit of $10,000. So, but at least it was terrific, and everybody waited till the last minute. And now the rate for the next 6 months is 6.47%. It's still a much better rate than your bank gives you, but you have to hold them for a year. And you have to pay a 3-month interest penalty if you sell them before 5 years. You don't go to your bank and buy them anymore. I'm going to show you how to do it. And they still make a nice gift for grandchildren. But that's a long time to tie your money up when you're a senior. Now, this part is so important. This is not for rich folks. You can do this with $100. And nobody but me is running around literally drawing you a map of how to buy 6-month Treasury bills, 26 weeks. If that's too long for you, they also have 13-week, 3-month Treasury bills. Those are those IOUs from the federal government that the government uses to finance its deficit. I just take all that out. I won't go into that whole big national debt thing. But every Monday, there's an auction of Treasury bills, 3- and 6-month Treasury bills. At last Monday's auction, where are we today? Saturday, so probably also at this Monday's auction, the rate is 4.7% from the government, the U.S. government, the safest place in the world. They're the ones behind FDIC. You, with $100, can participate and own 6-month Treasury bills. The exact yield is set at the auction Monday, but it's a global trading market, and currently the trading market yield is about 4.7. It might come in at 4.68%, but unless something dramatic happens over the next 24 hours to the noon on Monday auction, it'll be about 4.7%. The minimum purchase is $100. And by the way, you pay no state income tax on that interest. Now, how do you do this? This is so easy. Oh, thank you, Ryan, for the notebooks. I'm going to have some more things for you to write down. I hope you have a pen. Get it out. TreasuryDirect.gov, www.treasurydirect.gov. Yes, it is safe. It is secure. If your computer is secure, if you have a home network, you're not going to sit in Starbucks and do this through the, through the ether, but you go to a computer that's secure. You go to TreasuryDirect.gov, and the first things you'll see are login or open an account, top right corner. If you haven't opened an account, you open an account. Here's all you need. You need your name, your address, your social security number. Yes, it is safe. I must get 4 emails a week, or I got a lot more when I first started showing people how to do this. And you also need your bank name. So your bank at Chase. You need your routing number that's on your check before your account number. It'll be 6 digits. I think Chase is 007130001 or something like that. I mean, I know that because I bank at Chase and I use it. You need your routing number and you need your account number, your money market or checking account. That's all you need. You submit, and then they ask you to choose a password. It's really, I promise you can do it. And if you want to know how, later I'll show you my website, terrysavage.com. There's a thing that says everything you need to know about T-bills. Click on that article. It'll actually give you the link, and you can go step by step. Then it says buy. There's a link. Now you've got an account, you've got a password. Sign into your account, buy. And there's a whole long list. 13-week bills starting Monday, whatever next Monday is going to be, December 3rd or 4th or whatever that is, December 10th, December 17th. You say, I have $4,000 sitting in my bank account, my money market account. I want to buy $4,000 worth of 26-week Treasury bills. Click Submit. And on Monday night, you will notice they took out not $4,000, but $3,917 because they leave the interest in there. You get it up front. And when they mature in 6 months, the $4,000 will drop back in. Now, there's one other thing. You could say when you submit, I want to buy $4,000 of 6-month Treasury bills, 26-week bills. There's a thing that says, at maturity, what do you want them to do? And you can click a box, automatically renew. Renew once, renew twice, renew 3 times. Whatever the rate is, when those mature, that's set by the global auction, I'll accept it. And then in 6 months, more interest will drop in, but you'll still have your $4,000 riding. Okay? Don't complain to me that you're only getting 1% at your bank. You can do this. Every single one of you can buy Treasury bills. If you need some money liquid for an emergency, bail your grandchild out or something like that. But if you've got money sitting around in a bank CD, as soon as it matures, do this. And if it's in a money market, do it tonight. So you'll get in on Monday's auction, which should be around 4.7. How am I doing on time here? I have so much I want to tell you. Okay. I want to explain a concept. It's a pretty sophisticated concept, but this year, people who owned, forget treasuries now, just bonds, mutual funds with bonds in them. If you have an account, your broker said, we're going to be conservative 5 years ago. You're getting your retirement, we'll put you 60% in stocks, and we'll put you 40% in bonds, because historically when stocks go up, that means interest rates are low and the economy's thriving, and then, the bonds will be a conservative thing. But wrap your head around this. You own a 20-year bond from a major corporation, AAA rated, not going broke. You bought it last year because you were so mad that you only got 0.5% in your CD. There was AT&T or something like that offering 20-year bonds at 3%. Now interest rates go up. Fast forward a year or two. And interest rates, the Fed's pushing rates up to stop inflation, slow the economy, and AT&T has to sell some more bonds, only in order to attract buyers. Now that government bonds for 10 years are yielding 3.5%, if this corporation wants to sell new 20-year bonds, they got to pay 4.5%. So you tie your money up for 20 years at 4.5%, you think that's pretty good. And then what happens to the value of your other old bonds? They're still terrific bonds, a company's going to pay, but anybody with cash will not give you $1,000 for your old 3% bond when they could, with $1,000, buy a new, equally safe 4.5% bond. So the market value of your bond goes down. And all of you who had bond funds, as rates rose, the price of your bond fund, the value went down. This is corporate bonds, municipal bonds. When interest rates go up, long-term bond prices go down. It's the first time ever in history that this year, in the first 6 months, people lost money in stocks, a lot of it, you saw that happen, but they also lost money in the conservative bond side of their portfolio. That's where chicken money comes in, the money that lets you sleep at night. Those companies whose bonds you bought aren't going broke. You're just stuck receiving a little bit lower interest. But there's risk in bonds as well as stocks. I could spend a half hour on that. I'm not going to do it. But when interest rates rise, bond prices fall. That's why chicken money is short-term CDs or treasury bills or money market accounts. You don't get rich, but you don't get poor. Now, I just want to say one word. I could do a whole show on the stock market, but over the long run, the stock market is a lot less risky than you might think. Now, I don't know what you think of as the long run at this stage, but I'm talking, well, let's show you. If you bought a portfolio of stocks, call it the S&P 500, and you go back over the last 100 years, and Morningstar did this, their Ibbotson market research, they found the following. This goes back from 1926 through the end of last year. If you held that portfolio, call it the S&P 500 index fund or something like it, large company American stocks with dividend reinvested, the 1-year period is the blue bar. If you took any 1-year period in that last nearly 100 years, you had a 50-50 chance of being above the middle line, making money, or losing money. Then they looked at every single, the green bar, 5-year period. And now you see that if you picked any 5-year period, you had about a twice as large a chance of making money as losing money, being above the line, being profitable, or losing money. Okay, you're way ahead of me. Let's go all the way over to the pink bar. The pink bar is 20-year holding periods. Now watch this carefully. There has never been, going back to 1921, a losing period, 20-year period, for a diversified portfolio of large company American stocks with dividends reinvested. And then someone's going to say, but what about inflation? We see the gap between the axis here, that little small gap, that represents 3%. And 3% is the average historical inflation rate, going back over that 100 years. So now I'm going to say it again. Even adjusted for inflation, there's never been a 20-year period where you would have lost money in a diversified portfolio of large company American stocks with dividends reinvested. Today you can do that by buying the S&P 500 mutual fund in your 401k plan. Tell your grandchildren, it's not for you, I know. 20 years is like, wait, I'm going to use some of that during my 20 years, so I can't afford to have it all in there. But what if I want something that will beat inflation? I better have some stocks, assuming I have those decisions to make. And it's not just like, I only have this much money, I can't lose it. Over the long run, stocks offset inflation. Would you say that at the Christmas dinner table to your children, your grandchildren? Over the long run, they need to keep saving in their IRA or 401k and just put it in the stock market. They don't have to beat the market. All they have to do is be the market. They'll be fine. Okay, here's the big challenge of retirement. Making your money last as long as you do. That's it. That's absolutely it. All right, I got right to the nuts of it. But I want to say something about money after retirement because it's a lot different. During your lifetime when you were working, money is like a river flowing through your life. You have income, and the river's flowing, and you divert some to mortgage payments, and you divert some to groceries, and some to vacations, but it's always flowing through your life. When you get to retirement, the money you have is like a swimming pool. It's there. That's it. That's the water level. And every time you dip into it to take some out, the water level goes down. It requires a big change in thinking. See, I just was telling you to tell your grandchildren to be sure they're investing because I believe in America. You plotted that line, you believe in America. But we have a whole different approach once you're retired. It's called, now how do I deal with that money that I have? So the big retirement questions are, how do I make my money last my lifetime? And then how do I make sure my money will buy my lifestyle, which is why I talked about inflation first. Yeah, inflation is a big economic phenomenon that you're going to discuss over dinner. What's the Fed doing? What the heck are they doing? They're going to kill the economy. And you're going, yeah, please knock out inflation because I only have so much money. I found a way now I can buy T-bills. I can sort of keep up with it. I'm not getting ahead. And you young folks, you don't care because you're just going to ask for a raise. I can't get a raise. So the retirement planning risks. Here's one you hadn't thought about. I just want to hit through these briefly. Longevity risk. Remember I mentioned 10 years? I know that's in your head. It's in my head too. 10 years is something we can divide by 10. I'm very bad at dividing by 8 or 9 or 13 is just, that would wipe me out. But 10 years we get a rough feel for it. But the question is, how many 10 years do you have ahead of you? If we all knew we were, in the olden days of my grandparents, they retired at 65, they had a life expectancy of 69, that was 4 years. You divided your money into quarters and you figured I'll spend a little more the first year, I might not make it to 70. But now, life expectancies are changing and so forth. So how long will you live? Timing risk, I want to come back to that. Beware of the averages, I gave you a lot of average returns. Inflation risk, I think we've covered that. Stream of income risk, I want to talk about that. And then the most unexpected cost. So let me try, I'm only halfway through, Ron, sorry. Longevity risk. You don't know how long you're going to live. This is a cartoon in my book from the Wall Street Journal. They gave me permission. The financial strategy for my retirement should count on me still being alive, as he goes to the financial planner. Who knows? Well, here's something you can do if you want to. I like younger audiences to do this. Living to100.com. It's a website. You put in things like, how old are you now? How old are your siblings? How old were your parents when they passed on? And then your life habits. Do you wear your seatbelt every time you drive? Do you eat green vegetables? Do you exercise every day? Do you drink 8 glasses of water every day? Do you floss your teeth? Yeah, because it really impacts longevity. And then you click and you get an answer for your expected life expectancy. When I was writing the book, The Savage Number, How Much Money Do You Need to Retire? Well, it was back when it was the accumulation stage. I clicked and it said 104. And I went, wait, none of my plans say 104. I better be a little more honest about the exercise and the green vegetables, you know. I clicked again, I got 96, so okay. I think that's interesting. All right, so, by the way, last year, this is an old thing, I've used this for 4 or 5 years now, Hallmark sold 85,000 happy 100th birthday cards. More every year. First of all, what do you give anybody who's 100? A card. They have everything. Okay, and you have a lot of grandchildren. Maybe that's it. But you could live longer. You always thought you were above average. You're here because of AARP. There is a wonderful calculator on the AARP website called the Retirement Nest Egg Calculator. Use it. Go to aarp.org and ask them, and then just click on Retirement Calculator. Search for that. It's everything. you want to be cool at Christmas dinner, you got your grandchildren around, their heads are bent over their thing, just say, hey, just go to AARP.org and then click retirement nest egg calculator, retirement calculator. You see that? Why don't you put in there how much you're saving now? You know, how long you think you're going to live. Okay? Get them started. I want to just say one quick thing. Beware of averages, because real life is never average. I give you average historical returns. But you know, you can drown in averages. This is a cartoon that also the cartoonist gave me permission. It shows a man who dies crossing a river with an average depth of 3 feet. Yeah, it was 6 inches deep at the edges, but it was 10 feet deep in the middle. If you happen to say, well, I've got $100,000 in 10 years, I could take $10,000 a year out, and it'll keep growing in my investments, so it'll be fine. And that happens to be that you take out the $10,000 in the first year and the second year, and you have a bear market, and now you're taking $10,000 out of your account has gone down. You could run out of money in far shorter time than 10 years. So beware of averages. You need some sophisticated financial planning. I'm going to give you a resource at the end. Okay, we talked about the pool. Look, this is very important. There's 2 kinds of money you have if you have savings. You have your principal, and you have the income you can earn on it. I just show you how to earn more on treasury bills. That income will come right into your checking account. Your goal is to create a stream of income and not dig into the principal until very near the end, or not dig into it at all and leave it to your children and grandchildren. Here's the number one thing, and there's a Social Security session. If you have the choice, because you have other retirement savings, never take Social Security early. You gain 8% a year by waiting till you're 70, plus you get the interim cost of living increases, and then you'll have a higher base on which you'll get future cost of living increases throughout your retirement. This is your only income adjusted income in retirement. For some people it's too late. Tell your grown kids. If you don't believe it and you want all the reasoning, my next column in the Tribune, not for Sunday, but a week from Sunday, will feature a whole discussion of that. Social Security is complicated. It's complicated more if you have a spouse. Now, some people, look, I'm going to tell you something. I'm a preacher of doing the right thing. I have a brother. He took Social Security at 62 after hearing me speak forever about this. If some people don't have a choice, he just thought, I don't know what he thought about his longevity expectations, but I can't save everybody, but read the column on Social Security that'll run a week from Sunday. Here is write this down. If you haven't retired yet or taken your Social Security, this costs $39. It's put up by famed economist Larry Kotlikoff, who's now become one of my dear friends. MaximizeMySocialSecurity.com. There are like 127,000 permutations of the kind of benefits decisions you have to make, especially if you have 2 spouses and they could take their Social Security in any given month up until age 70. The bottom line is, don't argue with me, don't tell me, but I paid in, I want to get it out. If you live longer and beat the averages, you want the highest base Social Security check for future cost of living increases. So yes, use your IRA money and don't take it till you're 70, and the argument's in that column. I don't have time. Now, I know that not everybody gets that choice, by the way. This is really interesting. But more than a third of people who get Social Security are getting it, and it's 90% of their income. I recognize that. I don't know who's who in this audience, but I know there are a lot of you because that's the way the world works. In fact, 2/3 of Social Security recipients get more than half of their income from Social Security. So some people don't have the flexibility to make these choices, and I understand that. But anything you can do to delay till your full retirement age, if you're not there yet, and tell your friends, don't take it at 62. Full retirement age is now about 67. Some of you have IRAs. You know that you're required to take the money out at age 72 now. How much? Depends on how much money you have in it. And your withdrawal is based on the value of your accounts at the end of last year. So watch this. Last year, if you have an IRA, your account had a lot of money in it. This year, both stocks and bonds fell, and you might have 20 or 25% less. Stock markets come back recently, so maybe it won't be so bad. But your RMD, required minimum distribution, is based on the value at the end of last year. This year, keep your year-end statements if you have 3 IRAs, because that's the amount that will be the basis for your RMD next year. You want to have some liquidity, some money markets in your IRA. Oh, 5 minutes, okay. I'm not going to do a Roth conversion, but you can read my books and columns. Okay. So if you have a required minimum distribution, next year is going to be based on the year end this year. When do you take it out? Anytime throughout the 12 months, but do not wait. If you haven't taken your RMD this year, take it out now. There's a huge penalty if you don't. Some of you say, I don't know, maybe I should just get another stream of income, an immediate annuity. Beware of every single person that's trying to sell you an annuity. Start right there. But there are some annuities where you give the insurance company a check, a sum of money. They look at interest rates and your longevity and your gender, and they say, okay, we'll give you a check a month for life. It could be your life or at least a 10-year minimum guarantee. But remember, what looks like a nice payout, I'll give you $50,000 now and you'll give me X $100 a month for life. That's great, but remember that inflation, rule of 72. Let me hit on this. If you have a home, a reverse mortgage can be a terrific solution if you plan to stay in the home for a long, long time. I did this for my father. He wanted to stay in his condo overlooking the ocean, and he did till the week before he died at age 96. And they'd send people around. Is Jerry still living there? Oh, yeah, he walks on the beach every day. He got a lot of money out of his. You can never run out of equity. He pulled a lot more out than the condo ultimately was worth. But you can never be forced to sell because you ran out of equity. But you have to be able to have enough income to pay the property taxes and the insurance. And then when you die, your heirs can buy it back for all the money plus the interest on the money that was pulled out. Or like we did with my dad's condo, we said, no, it's not worth that anymore, you keep it. Don't worry about the banks that make these reverse mortgages, but because they're insured against losses. And AARP does the counseling about reverse mortgages. You're already here. I always mention AARP for counseling, so consider that. Now I want 2 more topics. Healthcare in retirement. You have no idea, because you thought Medicare would cover everything, how costly healthcare will be. And this is a new Fidelity study. The Fidelity says that a couple age 65 in 2022 may need approximately $315,000 saved after tax, not in your IRA, to cover healthcare expenses in retirement. What are those healthcare expenses? They're the premiums you pay for Medicare and supplement and uncovered expenses and co-payments and any other things. So now, today, you're making a big decision. And this is so totally important. And we're going to we promise next year, Courtney, we're going to do an AARP something on this, whether we do a webinar, come running around. You need to understand the difference between traditional Medicare and Medicare Advantage. And before I say anything about it, I want you to ask yourself how they get the money to pay Joe Namath, William Devane, who else have I seen on TV? And, my former sex symbols who are now like, no, I have Medicare Advantage. I promise you not one of them is on Medicare Advantage, okay? And I'll show you why. But they're getting paid a lot from the companies that tell you they're giving you a great deal. Okay, I've been writing about this for 3 or 4 years, and I find my soul sister here. It's Courtney Abram, and we're going to do a thing together. First of all, traditional Medicare is a pain. But it gives you your choice of doctors and hospitals. Everybody takes Medicare more or less. Part A is free. You sign up when you're 65. Part B, yes, there's a monthly premium. If you're still earning a lot of money, it could even be a pretty significant monthly premium. But it doesn't cover everything, so you have a supplement you have to buy. So you go online and Medicare.gov and you check the supplements. You probably all have F because you started earlier. That's the best supplement. Now the best supplement going forward is G, the most comprehensive. It also costs the most. But it's just going to cover just about everything. G doesn't cover your annual deductible. Other than that, you have no co-payments, no anything. But wait, there's more. You also have to buy not only your Part B, pay for it, and your supplement, you have to get Part D, the drug program. Even if all you take is a Tylenol or an Aleve, you sign up for a D drug program. But if you do take a lot of statins and other things, you go on Medicare.gov, one of the great websites of all time, and you create your own account, and you put in, I'm Joe Smith, and you line up your pill bottles. I take 50 milligrams of this and that and the other thing, and it clicks and it shows you which Part D drug program is better for you this year, and you must do it like tomorrow because it changes every year because the drug plans change what they include or what they price these things at. So it's really easy to do, and then you click and sign up for a new drug plan. So that's a real pain in the neck. But it gives you choice. It lets you know, well, if you want to take a name brand generic drug, or you want to take a name brand drug or a generic, this is what it'll cost. Now come all the TV commercials. Medicare Advantage all in one. Don't worry about those 4 payments you have to make. You may qualify for Medicare Part C, or screw you plan. It has a low monthly cost, or it has no monthly cost. We may even put dollars back in your Social Security check. Yeah, because let me finish this. Just because they're not taking Medicare Part B out of your Social Security check, which everybody is. So now you get a bigger Social Security check. And you will have everything, and you'll get dental, and you'll get hearing, and you'll get trips to the zoo. But the thing is, once you're in there, you have a limited choice of doctors and hospitals, only the ones that are in your plan. If you go out of network to get a second opinion on that surgery, it's going to cost you a fortune. In fact, you can be charged co-payments and all kinds of things. Maximum out of pocket for this year will be $8,300 in the plan, and over $12,000 if you go out of the plan. So Advantage works until you get sick. And then you start paying. Now you say to yourself, oh, I'm sick, this is horrible. I'm going back to traditional Medicare, it covered everything. But once you're sick, you can't get back into that original supplement plan that covered everything. Okay, yes, you can go back, but you can't get the great supplements. So you're caught either way. If you can possibly help it, and I know some people can't, and you want to check very carefully in an Advantage plan, who are the doctors in their network, who are the hospitals, and that could change every year. It might look lower cost, and it'll be fine until you get sick. Okay, well, I got to do this. Long-term care insurance. That is something any of us want to think about, and women particularly think of being a bag lady, but you're going to pay over $100,000 in nursing homes, which nobody wants to go to, but assisted living. It's a lot of money. I'm going to give you some information about long-term care insurance and an important number. I get nothing out of this. You don't have to mention my name. Long-term care insurance I've been talking about for 25 years. And it was a great thing. You paid a premium, you signed up when you were 60. The premiums wouldn't go up just because you got sick. But the premiums were wasted if they weren't used. Then we had that period of low interest rates. It hit the insurers, and they started telling the state commissioners of insurance, we're going to go broke. People decided they wanted to move into assisted living. It's nice. It's not the old nursing home. People using their policies when they can't do this, that, and the other thing. We're going to raise premiums, and if you had a policy, the premiums went up. Now there is a new kind of policy. It's combined life and long-term care. So if you use the policy, it's there. You make a deposit over 1 year or 5 years or 10 years. You get leveraged up and you get a lot of long-term care coverage. But if you don't use the care, then there's a death benefit for your heirs, so it's not money down the drain. I'm going to give you the number because I don't have time to do this now, but you can look up long-term care at my website. 800-533-6242. That's Murray Gordon and Associates. They are the experts in long-term care insurance. I don't get paid for any endorsements. You all know that. I don't sell anything. I get no kickbacks from my website. Nothing. But you can ask for Brian, Murray, or Peter, and they are the experts. 800-533-6242. They're out in Deerfield or Northbrook or something like that. Because people say, well, but I have a nice big pension. I could pay for my nursing home. Yeah, but then it goes to the nursing home. This way, if you don't use it, if you need the long-term care insurance, there's a death benefit that goes to your kids. And if you don't need it, then you've still got the money in your account. That can go to your kids. But why not insure against it? And Oh, you're going to have a whole seminar on this. I'm sorry, but you can't stop me. You must have an estate plan. That's not about rich people. A revocable living trust is a trust that you create while you're alive, and you name someone, if you have a stroke, to be able to do things with your money. You're going to have a whole seminar on this, so I hope you'll go attend. You also need a healthcare power of attorney. Everybody sign a healthcare power of attorney. You give your physician a copy so that if you're in the hospital, someone has to make decisions. That's different than the living will, the pull the plug document. Think about who you want to give these powers to. Go check the beneficiaries of your IRAs. Make sure it's not your ex-wife on the life insurance. And I'm going to show you how to get organized. Oh, first this. Those of you who have asked me over the years for where do I get financial advice? Can I hire you, Terry? No, I'm not in that business. But there is on my website a link to wealthramp.com. My friend Pam Kruger, who I do a podcast with, created a website that matches you with fee-only, no commissions, no sales pitches, fee-only, fiduciary, put your interests first, financial advisors. You will talk with her. She's got only a couple hundred of them across the country. And if you're looking for someone to go over all these things with you on a personal basis for a fee, someone you can trust, go to wealthramp.com or see the link on my website. And here's my website, terrysavage.com. You'll see my videos, you read my columns, you can post questions on my blog. Up on those 4 right boxes is Ask Terry a personal finance question, a link to WealthRamp, find your advisor. And down there, personal financial advisor form organizer is this. This form, which you can click on, print out blank, print as many copies as you want, hand them out at Christmas dinner. You fill them out. You don't leave this lying around. You don't have to tell your kids what you're leaving them, but you owe it to them. This is my bank account. These are my passwords for online. Put it somewhere safe, not in your safe deposit box, because they won't know where the key is, except you'll write it down on this form. But to someone you trust, this will tell them where everything is if you're incapacitated or die suddenly. And you can reach me. You follow me on Facebook, The Savage Truth, or you can email me, terry@terrysavage.com. That's The Savage Truth. Thank you. I tried to get through all of it. How'd I do, Ryan? Oh, we have questions. We have time for questions?
Thank you, Terry, very much. Please give her a great round of applause.
Thank you.
So, thank you. Great job.
Thank you.
We have a couple of surprises here. Terry's generosity. We have some books that she has provided for us, and there are some winners of those books today. So I'm going to read those names off. We have a table set up for her over there on the side.
The raffle thing, right?
On the side here. So I'm going to read the names off, but if your name is called, wait until she gets over to the table, and she'll be able to meet with you and even autograph your book for you. And also, if anybody in the audience, we're out of time to take questions, but if anybody in the audience has questions of her individually, she will be sitting over there as well for a little while. Okay. So thank you all. And I'm going to go ahead and read the names, and then we're going to go, once I read the names, we're going to break out into the individual sessions, which I highly encourage you all to go. We've got the Director of the Department on Aging here. We have the Cook County Assessor here, Fritz Kagi. We have...
That's astounding that the county assessor
I see you standing back there and back. And we have several other financial advisors in groups. So.
I want to meet you.
Yep. And Terry wants to meet him too.
The guy with the target on him.
So if your name is called, I'm going to read the names now. So Jacqueline Mullen.
I'll let you do that. Now
Bess Page. Linda Reyes. John O'Carroll. I think I'll pronounce this right. Mark Walbrun. Jose Avalos. Denise Martin. I think I have something. Oh, I lost one here. Mark Atchison. Tom Willer. Kathleen Vanna. And those are all the winners for the books. So if your name was called, go over to that table. and you will get your book, and Terry will autograph it for you. Just a couple of notes here. During the day, we're going to be doing a survey in Social Security. So there's going to be people walking around asking you questions about Social Security, the AARP volunteers in the red shirts. Please, we encourage you to fill that out. And the reason that we're doing that is because we want to hear from you about the program itself. And we're going to be doing a lot of work over the next couple of years educating and informing, and we will use that information to prepare our programs on the Social Security Initiative. And it allows us to do some thinking about the future of the program in general, and we can prepare you for that. Or you can take the survey. If you don't want to do that with one of our volunteers, we have a QR code up on the screen right now, and you could hold your phone up to that with the photography piece and click on the link that the QR code will take you to, and you can do the survey that way. It is anonymous. You don't need to put your names in. We just want to hear from you about Social Security. So thank you very much. We will be back here, so I just want to say, if you leave your seats stuff here, you could do that, but I would encourage you just to take it with and go to the breakout rooms, and then we will be coming back here for lunch. And just know, too, that the winners here, I'm going to put these names back in the drawing because we still have a sweepstakes drawing with some much bigger prizes that will be given out later in the day. So those of you that want a book could also possibly win the sweepstakes, but you're all still in the drawing for the sweepstakes prizes that we have for later today. So thank you very much. I'll talk with you later.
Get your money ready for your next priority with AARP's trusted financial tools. Because the younger you are, the more you need AARP. Start planning today at aarp.org/money.
today. When it's cold outside, I've got the month of May. I guess you said, what can make me feel this way, my girl, my girl, my girl. Talking about my girl, my girl. I've got so much honey, the bees into me. I've got a sweeter song than the birds.